This material is created by EasyPathUni by coordinations with Yazan Ibrahim.
Welcome to the deep dive. Have you ever, looked at a company's financial report and just felt like you're hitting a wall of numbers? Like you see the data, but it doesn't quite tell a clear story.
Absolutely. It can feel pretty opaque sometimes.
Well, today we're pulling back the curtain on that. We're talking about the hidden language behind those numbers. These are the foundational principles that really transform raw transactions into a reliable, understandable narrative of a company's financial health.
Yeah, and we're drawing our insights from pillars of accounting, principles and practices. We're focusing on those key chapters that lay out these essential guidelines.
Exactly.
And our mission for you today is, well, pretty simple, actually. We want to give you a shortcut to understanding the core rules that ensure financial information is consistent, transparent, and comparable.
Right. Cutting through the jargon.
Exactly. We want to reveal not just what these rules are, but the fundamental why behind them, why they actually matter. Absolutely.
Yeah.
Because whether you're, say, prepping for a board meeting, or maybe exploring a new field, or even if you're just curious about how companies work financially, grasping these principles is key. It really is about getting to those aha moments quickly.
So you can actually understand what you're looking at.
Precisely. Make sense of all that complex financial data. Okay, so let's dive in. Where do we start? I guess with GAAP.
Yeah, GAAP is the perfect starting point. Generally accepted accounting principles.
Right.
Think of it as the comprehensive rule book. It's the foundational framework for how financial transactions get systematically recorded, analyzed, and then, reported.
And its purpose. It's not just rules for rules' sake, is it?
Oh, definitely not. GAAP's overarching purpose is really fascinating. It provides these standardized guidelines precisely to ensure, well, three key things: consistency, transparency, and comparability.
Okay. Consistency, transparency, comparability.
Right. Across different companies and also over time for the same company, this standardization is absolutely crucial.
Crucial.
Because it allows stakeholders, investors, creditors, employees, management, everyone, really. It allows them to make properly informed decisions based on reliable information. You need that apples-to-apples comparison.
Otherwise, you're comparing, well, squishy oranges, as you said before we started.
Exactly. Squishy oranges, not very helpful.
Okay, so within this big GAAP framework, what's a really core principle that helps us see the true financial picture, maybe beyond just when cash changes hands?
That would definitely be the matching principle. It's fundamental.
The matching principle. Okay, what's the core idea?
It dictates that revenues and the expenses incurred to generate those revenues, they should be recognized in the same accounting period.
Okay, so linking the effort with the reward, kind of.
Precisely. It prevents accounting smoke and mirrors. Think about it. Without matching, a company might look incredibly profitable one month just because a big payment came in, even if the actual work and costs tied to that revenue happen over several months. Matching forces transparency about the true profitability of operations during a period.
Not just the cash flow timing. That's a really crucial distinction.
Yeah.
It connects cause and effect.
Exactly.
So matching links those economic realities.
Right.
What about establishing like a firm, unbiased starting point for what a company actually owns, the assets?
Well, that leads us perfectly to the historical cost principle.
Historical cost. Sounds straightforward.
It mostly is. It simply states that assets should be recorded at their original purchase cost.
And the value there.
It brings objectivity and reliability. That cost is usually verifiable, through invoices and records. It maintains the integrity of the balance sheet.
Okay, objective and reliable. But does it have any downsides?
Well, the key thing to understand is that while it provides that stable, verifiable basis, it also means the balance sheet might significantly understate the current market value of some assets.
Like real estate bought decades ago.
Exactly, or other long-held assets. So it's a trade-off. You get stability and verifiability, but you might lose that current market valuation perspective on the balance sheet itself.
Interesting. So objectivity is prioritized, even if the numbers don't always reflect today's market prices. Got it. Now, you mentioned comparability earlier as a key goal of GAAP. How do we ensure you can actually compare financial statements from one year to the next?
That's where the consistency principle comes in. It's vital.
Consistency, so using the same methods.
Exactly. It emphasizes using the same accounting methods and practices in financial reporting, period after period.
And the benefit for, say, me reading the statements.
The benefit for you is clear. It ensures the numbers remain comparable over time. You can track performance, spot trends accurately.
Knowing that any changes aren't just because they switched accounting methods.
Precisely. Now, it doesn't mean a company can never change methods. Sometimes there are good reasons to. But if they do, the consistency principle demands they fully disclose the change and explain its impact. So you understand why the numbers might look different year over year. Comparability is maintained, even with the change.
That makes a lot of sense. You want to see genuine performance shifts, not just accounting tweaks.
Spot on.
So with all these rules, how much detail is actually needed? Like, does every single tiny expense need its own line item? Sounds like there must be some judgment involved.
There absolutely is, and that's where the materiality principle comes into play.
Materiality.
Okay.
Significant items only.
That's the core idea. It suggests that only significant items, things that would likely influence the decision of a user of the financial statements, need to be reported according to strict JAP rules or disclosed separately.
So it recognizes that not every tiny detail is essential for decision-making.
Exactly. It enhances clarity and relevance by focusing on what truly matters. But significant or material? Well, that isn't always black and white.
How is it decided then?
It's often a blend of quantitative factors, like a common benchmark might be 5% of net income, for example, but also crucial qualitative factors.
Qualitative, like what?
Well, for instance, even a small error, quantitatively speaking, could be highly material if it, say, helps a company meet an earnings target or hides a potential fraud or allows them to meet a loan covenant they'd otherwise violate.
So context is key.
Context is everything. It allows accountants to use their professional judgment to decide what information is genuinely material to someone like you trying to understand the company.
Okay, that adds a layer of nuance. Professional judgment within the rules. And one last principle for this section. What happens when there's uncertainty? If there are two ways to account for something, and one looks better than the other, what's the guiding light?
The guiding light there is the conservatism principle.
Conservatism. Sounds like playing it safe.
That's a good way to put it. It suggests that when accountants face uncertainty, they should err on the side of caution. Meaning, they should generally choose the option that understates assets and revenues, or overstates liabilities and expenses, rather than the other way around.
Why do that? Why not present the most optimistic picture aloud?
The point is to prevent overly optimistic portrayals. It ensures a more conservative and hopefully more reliable representation of the company's financial position. It helps build trust.
So the company's health might look slightly more modest than the absolute best-case scenario.
Potentially, yes. But it fosters reliability and credibility in the long run. Now, what's really fascinating is how these principles, particularly matching and the idea of recognizing economic events when they happen, how they lead us directly to a fundamental concept: accrual accounting.
Right, accrual accounting. This feels like a big one.
It is. Accrual accounting means revenues and expenses are recorded when they are earned or incurred.
Regardless of when the cash actually moved.
Exactly. Regardless of when cash is received or paid.
And this is different from just tracking cash, right? Like a simple checkbook register.
Very different. That's cash accounting. Accrual accounting aims to give a much more accurate picture of a company's performance during a period.
How so?
By aligning revenues and expenses with the periods in which they actually contribute to generating income or are used up. It gives you, the reader, a much more comprehensive understanding of the business's actual financial health.
Not just its bank balance on one particular day. That makes sense. It sounds more economically true.
That's a great way to put it, economically true. And this brings us right back to the matching principle we discussed earlier.
Ah, okay. How does it fit specifically within accrual accounting?
Well, it's really a cornerstone of sound financial reporting under accrual accounting. It reinforces that whole idea.
Okay.
It dictates that expenses should be recognized in the same period as the revenues they help generate. This connection is vital under accrual. It enhances both the relevance and the reliability of the statements by giving you that clearer picture of the true costs of earning revenue.
Got it. So matching is key to making accrual accounting work properly. And building on that, another critical piece must be revenue recognition, right? Deciding when exactly to count something as revenue under accrual.
Absolutely critical. According to GAAP and also International Financial Reporting Standards, or IFRS, revenue is generally recognized when it is earned and realizable, and crucially, when collectability is reasonably assured.
Okay, earned and realizable. What does earned mean in practice?
It generally means when the company has substantially completed what it must do to be entitled to the benefits represented by the revenue. Usually, this means when goods are delivered or services are rendered.
So again, it's tied to the economic event, not the cash receipt.
Precisely. The revenue should be recorded in the accounting period when the goods or services are actually delivered, providing that faithful representation of the company's revenue-generating activities for that period.
Even if the customer pays later.
Even if the customer pays later or paid earlier, the timing of the cash is secondary to when the value is actually delivered. So if we sort of connect the dots here, you can see how accrual accounting, the matching principle, and proper revenue recognition all work together.
Yeah, they collectively contribute to the accuracy and reliability of the financial reports, don't they?
Exactly.
They acknowledge that business doesn't always happen neatly within calendar months or quarters. Transactions often span periods. So recognizing revenue and expenses when they actually occur economically, it just provides a much more faithful representation of the company's real financial position and performance.
It paints a more complete, more accurate picture over time.
Which leads to the big so what question, right? Why should someone listening care about all these principles?
Well, it really raises that important point. Why are these principles essential for you? Whether you're an investor deciding where to put your money, a creditor thinking about lending,
Or even management running the company.
Right. You absolutely rely on accurate, reliable financial information to make informed decisions. Decisions about the company's viability, its health, its future prospects.
So adherence to these principles isn't just some bureaucratic box-ticking exercise.
Not at all. It's fundamental to ensuring the integrity of the financial statements.
It fosters transparency. It builds trust among all the stakeholders.
Exactly. And even as the business world gets more complex, more dynamic,
Yeah.
these foundational principles remain absolutely crucial.
They maintain the credibility and the relevance of accounting in today's environment.
Couldn't agree more. So just to quickly recap the core takeaways from our deep dive today.
Yeah, let's summarize.
Okay, so accounting principles like GAAP provide that essential framework. Then you have specific rules like matching, historical cost, consistency, materiality, and conservatism that ensure transparency and consistency within that framework. And then concepts like accrual accounting, built on things like the matching principle and proper revenue recognition, take it a step further to give you that truly accurate, economically grounded picture of financial performance.
Right. It all fits together to create trustworthy financial information. So here's something to think about as we wrap up. Consider how these rules, which might seem really technical on the surface, how by fostering transparency and trust, they actually underpin the very foundation of how we assess economic health, how we make major financial decisions.
That's a great point.
So what implications might it have if a company doesn't rigorously follow these standards? And maybe more importantly, how might that impact your ability to actually trust their financial reports?
Yeah. What happens when that trust breaks down?
Something to definitely mull over.